Introduction. In recent years, cryptocurrency has become a hot topic, generating a lot of buzz and interest from people all around the world. However, for those who are new to the concept, it can be confusing and overwhelming. This guide has been created specifically for those who are just starting their journey in the world of cryptocurrency and aims to provide a comprehensive introduction to the topic. In this audiobook, we will take you through the basics of cryptocurrency, from its history to the various types of cryptocurrencies available today. We will also explain the underlying technology that makes it all possible, including blockchain and distributed ledger technology. You will learn about the various benefits and drawbacks of cryptocurrency, including its potential for investment and the risks involved. We will also guide you through the process of buying and selling cryptocurrency, as well as securing your digital assets. Our goal is to provide you with a clear and concise understanding of cryptocurrency so that you can make an informed decision when it comes to investing or using these digital assets. Whether you are a complete novice or have some basic knowledge already, this audiobook will provide you with the tools and information you need to get started in the world of cryptocurrency. Chapter 1. Cryptocurrency 101. Cryptocurrency is a digital or virtual currency that uses cryptography for secure financial transactions. Cryptocurrencies are decentralized systems that use distributed ledger technology, such as a blockchain, to record transactions and manage the issuance of new units. Cryptocurrencies are typically designed to be secure, anonymous, and resistant to fraud. They are often used as a form of investment and can be traded on various online platforms. Some of the most well-known cryptocurrencies include Bitcoin, Ethereum, and Litecoin. Cryptocurrency transactions are typically fast and cheap, as they do not involve intermediaries such as banks or credit card companies. However, cryptocurrencies can be volatile and their value can fluctuate significantly. They are also not regulated by governments or financial institutions, which can make them risky to invest in. Cryptocurrency works by using cryptography to secure financial transactions and to manage the creation of new units. It is a decentralized system that is not controlled by any single entity, such as a government or financial institution. Transactions are recorded on a decentralized database called a blockchain, which is a digital ledger of all transactions. The blockchain is secured through the use of complex mathematical problems that must be solved in order to add new blocks to the chain. This process is called mining. Cryptocurrencies use cryptographic protocols to verify the authenticity of transactions and to prevent double spending, which is when a unit of cryptocurrency is spent multiple times. Users can buy, sell, and trade cryptocurrencies on online platforms called exchanges. Cryptocurrencies can be used to purchase goods and services online, or they can be held as a form of investment. However, the value of cryptocurrencies can be volatile, and their legal status varies from country to country. Chapter 2. History of cryptocurrency. Cryptocurrencies are digital or virtual currencies that use cryptography for secure financial transactions and to verify the transfer of assets. The first and most widely known cryptocurrency is Bitcoin, which was created in 2009. The concept of a cryptocurrency can be traced back to the 1980s, when computer scientists attempted to create a secure and anonymous way to exchange digital messages. However, it was not until the release of Bitcoin that the idea of a decentralized digital currency became a reality. Since the release of Bitcoin, hundreds of other cryptocurrencies have been created. These cryptocurrencies, often referred to as altcoins, use similar technology as Bitcoin, but may have different characteristics and purposes. The use of cryptocurrency has become more mainstream in recent years, with a growing number of businesses accepting it as a form of payment. However, the use of cryptocurrency is still not as widespread as traditional fiat currencies, and it remains a topic of controversy and debate among governments, financial institutions, and individuals. The identity of the individual or individuals behind the creation of Bitcoin, known under the pseudonym Satoshi Nakamoto, is still unknown. Satoshi Nakamoto released the Bitcoin white paper in 2008 and released the first version of the Bitcoin software in 2009. Since the release of Bitcoin, many other individuals and organizations have contributed to the development and adoption of cryptocurrencies. These include early adopters and proponents of Bitcoin, such as the Winklevoss twins and Charlie Shrem, as well as companies that have developed and marketed their own cryptocurrencies, such as Ethereum and Ripple. There are also many organizations and individuals working on the development of blockchain technology, which is the underlying technology behind many cryptocurrencies. The use of blockchain technology has the potential to revolutionize a wide range of industries, including finance, supply chain management, and voting systems. Chapter 3: Blockchain. A blockchain is a decentralized digital ledger that is used to record transactions and track the transfer of assets. It is made up of a series of blocks, each of which contains a record of multiple transactions. These blocks are linked together in a chronological chain, with each block containing a cryptographic hash of the previous block, as well as a timestamp and other transaction data. The decentralized nature of the blockchain means that it is not controlled by any single entity, such as a government or financial institution. This makes it resistant to tampering and fraud, as any changes to the ledger must be verified by the network and can be easily traced. Blockchains are used in a variety of applications, including financial transactions, supply chain management, and voting systems. The most well-known application of blockchain technology is the creation and use of cryptocurrencies such as Bitcoin. When a transaction is made on a blockchain, it is broadcast to the network of nodes. The nodes then verify the transaction and add it to the next block in the chain, after which it cannot be altered. This process is known as mining. Once a block has been added to the chain, it becomes a permanent part of the database and can be used to verify the authenticity of subsequent transactions. In summary, a blockchain is a decentralized database that is used to store a list of records that are secured using cryptography and validated and recorded by a network of computers. It is a secure and transparent way to store and transfer data and has a wide range of potential applications, including finance, supply chain management, and voting systems. Chapter 4: Cryptocurrency Mining. Cryptocurrency mining is the process of verifying and adding transactions to the blockchain, which is the public ledger of all cryptocurrency transactions. In return for this work, miners are rewarded with a small amount of the cryptocurrency they are mining. Here's how cryptocurrency mining works. 1. Transactions are broadcast to the network. When a user initiates a cryptocurrency transaction, it is broadcast to the network of computers running the cryptocurrency's software. 2. Transactions are verified and added to a block. Miners who are powerful computers running specialized software work to verify the transactions and add them to a block, which is a record of multiple transactions. 3. The block is added to the blockchain. Once a block has been verified and added to the blockchain, It is permanent and cannot be altered. 4. Miners are rewarded. As a reward for their work verifying and adding transactions to the blockchain, miners are given a small amount of the cryptocurrency they are mining. Cryptocurrency mining requires a lot of computational power and energy, and it has become increasingly difficult to mine many cryptocurrencies as the number of miners has increased and the difficulty of the mining process has also increased. As a result, many miners join mining pools, which are groups of miners who work together to mine blocks and share the rewards. Chapter 5. Types of Cryptocurrencies. There are many different types of cryptocurrencies, also known as digital or virtual currency. Some of the most well-known types of cryptocurrencies include 1. Bitcoin. Bitcoin is a decentralized digital currency that uses cryptography for security. It was the first and remains the most widely used and valuable cryptocurrency. Pros. Decentralization. Bitcoin is decentralized, which means it is not controlled by any government, financial institution, or organization. This makes it resistant to censorship and fraud. Security. Bitcoin uses cryptography to secure financial transactions and control the creation of new units of the currency. This makes it difficult for hackers to steal Bitcoin or for users to cheat the system. Low transaction fees. Bitcoin transaction fees are generally lower than traditional financial institutions. Worldwide use. Bitcoin can be used anywhere in the world, as long as you have an internet connection. Cons. Volatility. The price of Bitcoin is highly volatile and subject to wide price swings. This can make it difficult to predict the value of Bitcoin in the short term. Limited acceptance. While Bitcoin is accepted by an increasing number of merchants, it is not yet widely accepted as a form of payment. Lack of regulation. Because Bitcoin is decentralized and not subject to traditional regulatory oversight, there is a higher level of risk associated with using it. Scalability. Bitcoin's network can process only a limited number of transactions per second, which can lead to delays and higher fees during times of high usage. It is important to carefully consider the pros and cons of Bitcoin before deciding whether to use it as a form of payment or investment. 2. Ethereum. Ethereum is a decentralized platform that runs smart contracts, applications that run exactly as programmed without any possibility of downtime, censorship, fraud, or third-party interference. At the heart of Ethereum is the Ethereum Virtual Machine, EVM, which executes smart contracts. The EVM is a decentralized, Turing-complete virtual machine that can execute scripts using an international network of public nodes. Pros. Smart contracts. Ethereum's smart contract functionality allows for the creation of self-executing contracts with the terms of the agreement between buyer and seller being directly written into the lines of code. This can streamline and automate many types of transactions. Decentralization. Ethereum is decentralized, which means it is not controlled by any government, financial institution, or organization. This makes it resistant to censorship and fraud. Customizable. Ethereum's platform is highly customizable, which makes it a popular choice for developers building decentralized applications. dApps. Security. Ethereum uses advanced cryptography to secure its platform and transactions. Cons. Scalability. Ethereum's network can process only a limited number of transactions per second, which can lead to delays and higher fees during times of high usage. Complexity. Ethereum's platform and programming language can be complex, which may make it difficult for non-technical users to understand and use. Regulation. Ethereum is not subject to traditional regulatory oversight, which may make it a riskier investment for some. Competition. Ethereum faces competition from other smart contract platforms, such as EOS and Tron, which may impact its market share and adoption rate. It is important to carefully consider the pros and cons of Ethereum before deciding whether to use it as a platform for building dApps or as an investment. 3. Litecoin. Litecoin is a peer-to-peer cryptocurrency that is similar to Bitcoin, but with faster transaction times and a different proof-of-work algorithm. Like Bitcoin, Litecoin is a decentralized digital currency that uses cryptography to secure financial transactions. It is based on the same open-source code as Bitcoin, but with some modifications to improve transaction speed and make it more suitable for small transactions. Litecoin uses a distributed ledger technology called blockchain to record transactions. A blockchain is a continuously growing list of records called blocks, which are linked and secured using cryptography. Each block contains a cryptographic hash of the previous block, a timestamp, and transaction data. Litecoin uses a proof-of-work (POW) algorithm to validate transactions and create new blocks. POW is a process in which miners compete to solve complex mathematical problems in order to validate transactions and add new blocks to the blockchain. The first miner to solve the problem is rewarded with Litecoin. Litecoin transactions are faster than Bitcoin transactions because Litecoin uses a different POW algorithm called Script, which is designed to be more efficient and require less processing power. This makes it easier for miners to validate transactions and add new blocks to the blockchain, which leads to faster transaction times. Litecoin can be bought and sold on cryptocurrency exchanges, and it can also be used to purchase goods and services online and in brick-and-mortar stores that accept it as a form of payment. Pros. Faster transaction times. Litecoin transactions are generally faster than Bitcoin transactions because Litecoin uses a different proof-of-work algorithm that is designed to be more efficient and require less processing power. Low transaction fees. Litecoin transaction fees are generally lower than Bitcoin transaction fees. Security. Litecoin uses advanced cryptography to secure its network and transactions. Decentralization. Litecoin is decentralized, which means it is not controlled by any government, financial institution, or organization. This makes it resistant to censorship and fraud. Cons. Volatility. The price of Litecoin is highly volatile and subject to wide price swings. This can make it difficult to predict the value of Litecoin in the short term. Limited acceptance. Litecoin is accepted by a limited number of merchants and may not be widely accepted as a form of payment. Lack of regulation. Because Litecoin is decentralized and not subject to traditional regulatory oversight, there is a higher level of risk associated with using it. Competition. Litecoin faces competition from other cryptocurrencies, such as Bitcoin and Ethereum, which may impact its market share and adoption rate. It is important to carefully consider the pros and cons of Litecoin before deciding whether to use it as a form of payment or investment. 4. Ripple. Ripple is a real-time gross settlement system, currency exchange, and remittance network created by Ripple Labs, Inc., a US-based technology company. The Ripple network allows for the transfer of any type of currency, including fiat currencies like the US dollar, as well as cryptocurrencies like Bitcoin. Transactions on the Ripple network are fast, with most taking just a few seconds to complete. Ripple uses a distributed ledger technology called blockchain to record transactions. A blockchain is a continuously growing list of records, called blocks, which are linked and secured using cryptography. Each block contains a cryptographic hash of the previous block, a timestamp, and transaction data. The Ripple network is based on a census protocol, which means that transactions are validated by a network of independent nodes rather than being mined like Bitcoin. This makes the Ripple network faster and more efficient than some other blockchain networks. Ripple's native cryptocurrency is called XRP. XRP is used to facilitate transactions on the Ripple network and can be bought and sold on cryptocurrency exchanges. Ripple also offers a range of payments and settlement products such as xCurrent and xRapid, which use XRP to facilitate cross-border payments and improve liquidity in international markets. Pros: fast transaction times. Transactions on the Ripple network are generally faster than other blockchain networks, with most taking just a few seconds to complete. Low transaction fees. Ripple transaction fees are generally lower than other blockchain networks. Wide range of uses. Ripple offers a range of payment and settlement products such as xCurrent and xRapid, which can be used for cross-border payments and improving liquidity in international markets. Strong partnerships. Ripple has established partnerships with a number of financial institutions and payment providers, which may increase its adoption and usage. Cons: centralization. Ripple is more centralized than other blockchain networks, as it is controlled by a private company and relies on a network of validated nodes rather than a decentralized network of miners. This may make it less resistant to censorship and fraud. Regulation. Ripple is subject to regulatory oversight and may be impacted by changes in regulation. Competition. Ripple faces competition from other payment and settlement systems, as well as other cryptocurrencies. Adoption. Ripple is not widely accepted as a form of payment and may have limited adoption. It is important to carefully consider the pros and cons of Ripple before deciding whether to use it as a payment or settlement system or as an investment. 5. Monero. Monero is a privacy-focused cryptocurrency that uses cryptography to hide the details of transactions and the identities of users. Like other cryptocurrencies, Monero is based on a distributed ledger technology called blockchain. A blockchain is a continuously growing list of records called blocks, which are linked and secured using cryptography. Each block contains a cryptographic hash of the previous block, a timestamp, and transaction data. Monero uses a proof of work (POW) algorithm to validate transactions and create new blocks. POW is a process in which miners compete to solve complex mathematical problems in order to validate transactions and add new blocks to the blockchain. The first miner to solve the problem is rewarded with Monero. One of the key features of Monero is its use of ring signatures and stealth addresses to obscure the identity of the sender and recipient of a transaction. A ring signature is a type of digital signature that allows a group of users to sign a message without revealing which member of the group actually signed the message. A stealth address is a one-time public address that is generated for each transaction, making it difficult for third parties to trace the transaction back to a specific user. Monero can be bought and sold on cryptocurrency exchanges, and it can also be used to purchase goods and services online and in brick-and-mortar stores that accept it as a form of payment. Pros: privacy. Monero uses advanced cryptographic techniques such as ring signatures, and stealth addresses to obscure the identity of the sender and recipient of a transaction. This makes it a popular choice for users who value privacy. Decentralization. Monero is decentralized, which means it is not controlled by any government, financial institution, or organization. This makes it resistant to censorship and fraud. Security. Monero uses advanced cryptography to secure its network and transactions. Wide range of uses. Monero can be used for a variety of purposes, including purchasing goods and services online and in brick-and-mortar stores that accept it as a form of payment. Cons. Volatility. The price of Monero is highly volatile and subject to wide price swings. This can make it difficult to predict the value of Monero in the short term. Limited acceptance. Monero is accepted by a limited number of merchants and may not be widely accepted as a form of payment. Lack of regulation. Because Monero is decentralized and not subject to traditional regulatory oversight, there is a high level of risk associated with using it. Competition. Monero faces competition from other privacy-focused cryptocurrencies such as Zcash and Dash, which may impact its market share and adoption rate. It is important to carefully consider the pros and cons of Monero before deciding whether to use it as a form of payment or investment. Chapter 6. Cryptocurrency Wallets. There are several types of cryptocurrency wallets, each with its own set of features and benefits. Some common types of cryptocurrency wallets include 1. Software wallets. Software wallets are applications that you can install on your computer or mobile device. They can be further divided into two categories: hot wallets and cold wallets. Hot wallets are connected to the internet and are more convenient to use, but they are also more vulnerable to hacking. Cold wallets are not connected to the internet and are considered more secure, but they are less convenient to use. 2. Hardware wallets. Hardware wallets are physical devices that store your cryptocurrency offline. They are considered one of the most secure types of wallets because they are not connected to the internet and are therefore less vulnerable to hacking. However, they can be lost or stolen, and they are not as convenient to use as software wallets. 3. Paper wallets. Paper wallets are physical documents that contain your cryptocurrency private keys and addresses. They are considered a secure way to store cryptocurrency because they are not connected to the internet and are not vulnerable to hacking. However, they can be lost or damaged, and they are not as convenient to use as software or hardware wallets. 4. Web wallets. Web wallets are online platforms that allow you to store and manage your cryptocurrency. They are convenient to use because you can access them from any device with an internet connection, but they are also more vulnerable to hacking because they are connected to the internet. It is important to carefully consider the pros and cons of each type of wallet before choosing one to store your cryptocurrency. Some factors to consider include security, convenience, and accessibility. Chapter 7. Pros and Cons of Cryptocurrency. One of the main advantages of cryptocurrency is that it is decentralized and operates on a peer-to-peer network, which means that it is not controlled by any government or financial institution. This decentralization makes it resistant to censorship and fraud and allows for fast and cheap transactions. Cryptocurrencies also offer greater privacy than traditional financial systems, as they can be used anonymously. However, cryptocurrencies are still relatively new and their value can be volatile. They are also not yet widely accepted as a means of payment, and their use is still restricted in many countries. In addition, the lack of regulation and oversight makes it difficult to ensure the security of cryptocurrency transactions and protect against fraud and money laundering. It is possible that cryptocurrencies could become more widely adopted and accepted in the future, but it is also possible that they will face regulatory hurdles or other challenges that limit their use. It is important to keep in mind that cryptocurrency is a highly speculative investment and that you should carefully consider the risks before investing. Cryptocurrencies have several potential advantages as well as some potential drawbacks compared to traditional currencies and payment systems. Here are some of the main pros and cons to consider. Pros: decentralization. Cryptocurrencies are decentralized, meaning that they are not controlled by any single entity or authority. This makes them resistant to censorship and interference, and allows users to maintain control over their own funds. 2. Security. Cryptocurrencies use advanced cryptographic techniques to secure transactions and prevent fraud. This makes them a safe and secure way to store and transfer value. 3. Fast and cheap transactions. Cryptocurrency transactions can be processed quickly, often within a few minutes, and can be much cheaper than traditional payment methods. 4. Privacy. Cryptocurrencies offer a high level of privacy as users are able to make transactions without revealing their personal information. Cons. 1. Volatility. The value of cryptocurrencies can be highly volatile, meaning that their value can fluctuate significantly over short periods of time. This makes them a risky investment as well as a potentially unreliable store of value. 2. Limited acceptance. Cryptocurrencies are not yet widely accepted as a form of payment, meaning that it can be difficult to use them in everyday transactions. 3. Regulatory uncertainty. The legal status of cryptocurrencies varies from one jurisdiction to another and is still not fully understood in many places. This can create uncertainty and risk for users. 4. Lack of consumer protections. Cryptocurrencies are not subject to the same consumer protections as traditional financial instruments, meaning that users may not have the same recourse if something goes wrong. Chapter 8. How to make money through cryptocurrency. There is the potential to earn a lot of money in cryptocurrency, as the value of some cryptocurrencies has increased significantly over time. For example, Bitcoin, the first and most well-known cryptocurrency, has seen its value rise from a few cents when it was first created in 2009 to over 60,000 in 2021. However, it's important to note that the value of cryptocurrencies can be highly volatile, meaning that their value can fluctuate significantly over short periods of time. This makes them a risky investment, as well as a potentially unreliable store of value. It's also worth noting that earning a lot of money with cryptocurrency is not a guarantee, and there are many factors that can affect the value of a cryptocurrency. It's important to thoroughly research and understand the different cryptocurrencies and the risks involved before investing any money. It's also important to diversify your investments and not to invest more money than you can afford to lose. If you are interested in earning money using cryptocurrency, there are a few steps you can take. 1. Research and educate yourself. It's important to thoroughly research and understand the different cryptocurrencies and how they work before investing any money. This will help you make informed decisions about which cryptocurrencies to invest in and how to securely store and manage them. 2. Choose a cryptocurrency exchange. In order to buy and sell cryptocurrencies, you will need to use a cryptocurrency exchange. There are many exchanges available, so it's important to do your research and choose one that is reputable and has a good track record. 3. Set up a wallet. A wallet is a digital storage tool that allows you to store and manage your cryptocurrency. There are different types of wallets available, such as online wallets, mobile wallets, and hardware wallets. It's important to choose a wallet that is secure and fits your needs. 4. Start buying and selling. Once you have chosen an exchange and set up a wallet, you can start buying and selling cryptocurrencies. It's important to monitor the market and stay up to date with the latest developments in the cryptocurrency space, as this can help you make informed decisions about when to buy and sell. 5. Be aware of the risks. While there is the potential to earn money with cryptocurrency, it's important to be aware of the risks involved. Cryptocurrencies are highly volatile, and the value of your investments can fluctuate significantly. It's also important to protect your wallet and take steps to secure your cryptocurrencies. Cryptocurrency investing. There is no surefire way to predict which cryptocurrency investing strategies will earn the most money. The cryptocurrency market is highly volatile and subject to a wide range of risks, including technical glitches, regulatory changes, and market manipulation. That being said, there are some general strategies that investors may consider when investing in cryptocurrency. 1. Diversification. Diversification is a risk management strategy that involves spreading your investments across a variety of assets to reduce the impact of any one investment on your overall portfolio. This can include investing in a range of different cryptocurrencies, as well as other asset classes such as stocks, bonds, and real estate. 2. Long-term investment. Cryptocurrency prices can be highly volatile in the short term, but some investors believe that certain cryptocurrencies have long-term potential and may be more suited to a long-term investment horizon. 3. Fundamental analysis. Fundamental analysis involves evaluating the underlying factors that can impact the price of a cryptocurrency, such as the technology, the team, and the adoption rate. This can help investors identify cryptocurrencies that have strong fundamentals and may be more likely to perform well in the long run. 4. Technical analysis. Technical analysis involves using historical price data and chart patterns to predict future price movements. Some investors use technical analysis as a tool to identify buying and selling opportunities in the cryptocurrency market. It is important to remember that investing in cryptocurrency carries inherent risks, and it is always advisable to do your own research and consult with a financial advisor before making any investment decisions. It's important to note that cryptocurrency investments carry significant risk and can be highly volatile. Past performances does not necessarily indicate future results, and there is no guarantee that any particular cryptocurrency will increase in value or return on investment. Other factors to consider when choosing a cryptocurrency to invest in include the project's technology and development team, the level of adoption and usage of the cryptocurrency, and the overall market conditions. It's important to do thorough research and due diligence before making any investment decisions. Chapter 9. How to get started. If you are new to cryptocurrency and want to get started, here are some steps you can take. 1. Research and educate yourself. It's important to thoroughly research and understand the different cryptocurrencies and how they work before investing any money. This will help you make informed decisions about which cryptocurrencies to invest in and how to securely store and manage them. 2. Choose a cryptocurrency exchange. In order to buy and sell cryptocurrencies, you will need to use a cryptocurrency exchange. There are many exchanges available, so it's important to do your research and choose one that is reputable and has a good track record. 3. Set up a wallet. A wallet is a digital storage tool that allows you to store and manage your cryptocurrency. There are different types of wallets available, such as online wallets, mobile wallets, and hardware wallets. It's important to choose a wallet that is secure and fits your needs. 4. Buy your first cryptocurrency. Once you have chosen an exchange and set up a wallet, you can start buying your first cryptocurrency. You can use traditional currency, such as US dollars, to buy cryptocurrency on the exchange. 5. Secure your cryptocurrencies. It's important to protect your wallet and take steps to secure your cryptocurrencies. This may include setting up two-factor authentication, using a hardware wallet, and keeping your software up to date. 6. Keep track of your investments. It's a good idea to keep track of your cryptocurrency investments and monitor the market to stay up to date with the latest developments in the cryptocurrency space. This can help you make informed decisions about when to buy and sell. This is the end of Cryptocurrency Guide for Beginners, an essential guide to navigating the digital asset landscape. Learn useful tips on investing and trading digital assets. Written by Dallas Brickwood. Narrated by Stephen Miles. This is Cryptocurrency Field Guide, your essential guide to digital currencies. Learn tips on navigating the crypto landscape. Written by Teresh Wilson. Narrated by Stephen Miles. Introduction. Cryptocurrency is a digital or virtual currency that uses cryptography for security. It has been a topic of significant interest in recent years, as the value of some cryptocurrencies has risen dramatically. This audiobook is designed for intermediate learners who want to learn more about the technology behind cryptocurrency and how it works. We will explore the different types of currencies available and how to safely buy, sell, and store them. Additionally, we will discuss the potential uses of cryptocurrency in the future and its impact on the global economy. By the end of this audiobook, readers will have a comprehensive understanding of the cryptocurrency industry and how to navigate it. Chapter 1. Understanding Blockchain Technology. Blockchain technology is the backbone of all cryptocurrencies. It is a decentralized digital ledger that records transactions across a network of computers. These transactions are grouped together in blocks, and each block is connected to the previous one in a chronological chain, hence the name, blockchain. One of the key features of blockchain technology is that it is secure and tamper-proof. This is because each blockchain in the chain contains a unique code called a hash, which is generated using complex algorithms. If someone tries to alter the information in a block, the hash will change, alerting the network that something is amiss. Another important aspect of blockchain technology is its decentralization. Unlike traditional ledgers, which are controlled by a central authority, blockchains are maintained by a network of computers. This means that there is no single point of failure and no single entity that can control the flow of information. The first blockchain-based cryptocurrency, Bitcoin, was created in 2009 by an anonymous individual or group of individuals using the pseudonym Satoshi Nakamoto. Bitcoin was revolutionary because it was the first digital currency that could be transferred directly between individuals without the need for a central authority. Since then, many other cryptocurrencies have been created, each with their own unique features and uses. Some, like Bitcoin, are primarily used as a form of digital cash, while others, like Ethereum, are used to build decentralized applications, dApps. Blockchain technology has many potential uses beyond cryptocurrency, such as supply chain management, digital voting, and secure online identity verification. As the technology continues to evolve, it is likely that we will see more and more innovative uses for blockchain in the future. 1. Supply chain management. Blockchain technology can be used to create a transparent and tamper-proof record of the journey of goods from the manufacturer to the consumer. This can help to reduce fraud, improve efficiency, and increase trust in the supply chain. For example, Walmart has been using blockchain technology to track the supply of pork in China and the movement of produce in the US. 2. Digital identity. Blockchain technology can be used to create a secure and decentralized digital identity for individuals. This can be used to verify identity, access services, and make transactions. For example, the government of Estonia has been using blockchain technology to create a digital identity system for its citizens, which enables them to access public services online. 3. Voting systems. Blockchain technology can be used to create a secure and transparent voting system. This can help to increase voter turnout and reduce the risk of fraud. For example, West Virginia has been using blockchain technology to create a secure online voting system for military personnel stationed overseas. 4. Banking and finance. Blockchain technology can be used to create a decentralized and transparent financial system. This can help to reduce costs, increase efficiency, and increase access to financial services. For example, the Central Bank of France is testing a blockchain-based platform for secure data sharing between banks. 5. Smart contracts. Blockchain technology can be used to create smart contracts, which are self-executing contracts with the terms of the agreement between buyer and seller being directly written into the lines of code. This can help to automate and streamline legal and business processes, reduce costs, and increasing efficiency. These are just a few examples of how blockchain technology is being used to deliver benefits in real-life situations. The use cases of blockchain technology are constantly expanding and evolving, as more and more industries are discovering the potential benefits of this technology. Chapter 2. Cryptocurrency Market Analysis. The cryptocurrency market is a rapidly evolving space, with new coins and tokens being introduced on a regular basis. In order to fully understand the market, it's important to analyze the different types of cryptocurrencies available and their specific use cases. The first and most well-known cryptocurrency is Bitcoin. Created in 2009, Bitcoin is considered the first decentralized digital currency. It is primarily used as a form of digital cash and is accepted by a growing number of merchants and businesses worldwide. Its value is determined by the market demand, and it has experienced high volatility in the past. Another popular cryptocurrency is Ethereum. Created in 2015, Ethereum is a decentralized platform that enables the creation of smart contracts and decentralized applications, DApps. It is also used as a form of digital currency, but its primary use is as a platform for building and running decentralized applications. Ripple is another well-known cryptocurrency that was created in 2012. It is primarily used as a form of digital currency for international money transfers and has partnerships with major banks and financial institutions. Other popular cryptocurrencies include Litecoin, Bitcoin Cash, and Binance Coin. Each of these coins has its own unique features and use cases, and the value of each is determined by the market demand. In addition to these major cryptocurrencies, there are also thousands of smaller coins and tokens available on the market. These coins and tokens are often created as part of an initial coin offering, ICO, in which a new project or company raises funds by issuing a new cryptocurrency. Many of these coins and tokens are highly speculative and carry a high level of risk. The cryptocurrency market is highly speculative and can be influenced by a number of factors, including market sentiment, regulatory changes, and global economic conditions. It's important to conduct thorough research and analysis before investing in any cryptocurrency. Chapter 3: Cryptocurrency Trading Strategies and Identifying Profitable Opportunities. Trading cryptocurrencies can be a highly profitable venture, but it also comes with a significant amount of risk. In order to be successful in the market, it's important to have a solid understanding of the technology behind the coins and to develop a well-crafted trading strategy. One popular trading strategy is to buy low and sell high. This involves identifying coins that are undervalued and have the potential to appreciate in value, then buying them at a low price and selling them at a higher price. This strategy requires a good understanding of the coin's underlying technology and its potential use cases, as well as the ability to anticipate market trends and price movements. Another strategy is called hodling, which stands for hold on for dear life, and it means to buy and hold a coin for a long period of time with the expectation that its value will appreciate in the future. This strategy is based on the assumption that the value of the coin will increase over time as more people adopt and use it. Another popular strategy is called day trading, which is the act of buying and selling a coin within the same trading day. This strategy is based on the assumption that short-term price movements are more predictable than long-term movements. It requires a good understanding of market sentiment and technical analysis. A more advanced strategy is called arbitrage, which is the act of buying and selling a coin on different exchanges at the same time to take advantage of price differences. This strategy requires a good understanding of the different exchanges and their order books. It's also important to keep in mind that cryptocurrency markets are highly speculative and can be influenced by a number of factors, including market sentiment, regulatory changes, and global economic conditions. Therefore, it's important to conduct thorough research and analysis before making any trades. Additionally, diversifying your portfolio across different coins and projects can also help to mitigate risk. Chapter 4: Portfolio Management and Diversification. Managing a cryptocurrency portfolio is an essential aspect of successful investing in the digital currency market. Diversifying your portfolio across different coins, projects, and trading strategies can help to mitigate risk and maximize returns. One important aspect of portfolio management is understanding the different types of coins and tokens available in the market. Bitcoin, for example, is considered a store of value and is often compared to digital gold. Ethereum, on the other hand, is used as a platform for building and running decentralized applications. Each coin has its own unique features and use cases, and it's important to understand how they may perform in different market conditions. Another important aspect of portfolio management is diversifying across different projects and trading strategies. For example, you can diversify by holding a mix of large-cap coins like Bitcoin, Ethereum, and smaller-cap altcoins. Additionally, you can also diversify by investing in both short-term and long-term strategies, such as day trading and hodling. When diversifying your portfolio, it's also important to consider your risk appetite and investment goals. A conservative investor may choose to allocate a larger portion of their portfolio to stable coins and blue chip projects, while a more aggressive investor may choose to allocate a larger portion to smaller, high-risk projects with the potential for higher returns. It's also important to regularly review and rebalance your portfolio to ensure that it aligns with your investment goals and risk tolerance. This may involve selling off underperforming assets and relocating those funds to other, more promising projects. In addition to diversification, another key aspect of portfolio management is risk management. This includes setting stop-loss orders, using proper position sizing, and using tools like dollar cost averaging to mitigate volatility. Ultimately, the key to successful portfolio management is to conduct thorough research, regularly review and rebalance your portfolio, and to stay informed about the latest developments in the cryptocurrency market. With a well-managed and diversified portfolio, you can navigate the volatility of the market and increase your chances of achieving your investment goals. Chapter 5: Risk Management Techniques. Managing risk is an essential aspect of investing in the cryptocurrency market. The market is highly volatile and prices can fluctuate significantly in a short period of time. As such, it's important to have a solid risk management strategy in place to protect your investments and ensure that you can navigate the market effectively. One important aspect of risk management is setting stop-loss orders. A stop-loss order is a type of order that automatically sells your position when the price reaches a certain level. This helps to limit your losses in case the price of a coin drops unexpectedly. Another important aspect of risk management is proper position sizing. This involves determining the appropriate amount of capital to allocate to each trade or investment. By not risking too much on any one trade or investment, you can limit your potential losses and preserve your capital for future opportunities. Another technique is dollar cost averaging, which is an investment strategy that involves buying a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. This helps to average out the cost of the investment over time and reduces the impact of volatility on the overall portfolio. Another technique is hedging, which involves taking an offsetting position in a related security to reduce the risk of an investment. For example, if you own a large amount of a particular cryptocurrency, you can hedge your position by shortening a futures contract of the same cryptocurrency. In addition to these techniques, it is also essential to stay informed about the latest developments in the cryptocurrency market and to conduct thorough research before making any investment decisions. By staying informed and using effective risk management techniques, you can navigate the volatility of the cryptocurrency market and increase your chances of achieving your investment goals. Overall, risk management is an ongoing process that requires regular monitoring and adjustments. The key to successful risk management is to have a clear understanding of your risk tolerance, investment goals, and to use a combination of different techniques to mitigate risk and protect your portfolio. Chapter 6: Security and Storage. Securing and storing your cryptocurrency investments is of the utmost importance. As the market is decentralized and largely unregulated, it is the responsibility of the individual investor to ensure the safety of their assets. One of the most important things to consider when it comes to security is the storage of private keys. Private keys are the unique code that gives you access to your cryptocurrency holdings, and if they fall into the wrong hands, your investments could be at risk. There are several different types of wallets and storage solutions available for holding and managing cryptocurrency investments. 1. Hardware wallets. These are physical devices that store your private keys offline, providing a high level of security. Your private keys are protected by a variety of security measures, such as a PIN code. They are considered to be one of the most secure ways to store your cryptocurrency. Examples include Ledger and Treasure. It is also important to take additional security measures, such as using strong and unique passwords, enabling two-factor authentication, and avoiding phishing scams. 2. Software wallets. These are digital wallets that can be accessed through a computer or mobile device. They are less secure than hardware wallets, but they are more convenient for day-to-day transactions. Examples include My Ether Wallet and Electrum. 3. Paper wallets. Another option for storing private keys is through the use of paper wallets. A paper wallet is simply a printout of your private key, which can be stored in a secure location such as a safety deposit box. Paper wallets are one of the most secure ways to store your cryptocurrency, but they are less convenient for day-to-day transactions. 4. Cloud wallets. These are digital wallets that are stored on remote servers. They are less secure than hardware and paper wallets, but more convenient for day-to-day transactions. Examples include Coinbase and Blockchain.com. 5. Multi-sig wallets. These are digital wallets that require multiple signatures or approvals before a transaction can be made. This adds an extra layer of security and can help prevent unauthorized access to your funds. Examples include BitGo and Armory. It is important to note that the level of security provided by a wallet or storage solution will depend on its specific features, so it is important to research and choose a solution that meets your security needs. Additionally, it is important to always keep a backup of your private keys and to use strong and unique passwords. Chapter 7. Initial Coin Offerings, ICOs. An initial coin offering, otherwise known as ICOs, is a fundraising mechanism in which a new cryptocurrency venture sells a portion of its cryptocurrency tokens to early backers of the project in exchange for legal tender or other cryptocurrencies. ICOs have become a popular way for blockchain projects to raise funds, as they allow for a faster and more decentralized alternative to traditional fundraising methods such as venture capital or initial public offerings, IPOs. However, it is important to note that ICOs are largely unregulated and carry a high level of risk. When participating in an ICO, investors are typically buying tokens that will be used on the platform or network that the project is building. The value of these tokens is derived from the utility they provide on the platform or network. Before investing in an ICO, it is important to do your own research and due diligence on the project and its team. This should include reviewing the project's white paper, which outlines the project's vision, goals, and technical details, as well as researching the background and experience of the project's team and advisors. It is also important to be aware of the risks associated with ICOs, including the risk of fraud, lack of regulation, and the risk that the project may not be successful and the value of the tokens may decrease. Despite these risks, many investors see ICOs as a potential opportunity for high returns. However, it's important to be aware that investing in an ICO is a high-risk and speculative investment. There are several risks associated with investing in initial coin offerings that investors should be aware of. 1. Fraud. One of the biggest risks associated with ICOs is the potential for fraud. Since ICOs are largely unregulated, There have been many instances of fraudulent projects and scammers taking advantage of investors. It is important to do your own research and due diligence on the project and its team before investing to try and mitigate this risk. 2. Lack of regulation. Another risk associated with ICOs is the lack of regulation. The lack of oversight and regulations can make it difficult for investors to protect their rights and recover their investments in case of fraud or mismanagement. 3. Lack of investor protection. Unlike traditional investments, there are no investor protection laws in place for ICOs. Investors have little legal recourse if things go wrong with the project. 4. Lack of liquidity. ICOs often result in creating a limited number of tokens, which can lead to lack of liquidity in the market. This could make it difficult for investors to sell their tokens when they want to, leading to a loss of value. 5. Risk of project failure. Investing in an ICO means investing in the success of a project, which carries a high level of risk. Many projects that have launched through an ICO have failed, resulting in a loss of value for investors. 6. Security risks. Investing in an ICO also carries security risks, such as hacking, phishing, and other forms of fraud. 7. Risk of regulatory changes. The legal landscape surrounding ICOs is constantly changing, and new regulations or bans could negatively impact the value of the tokens. 8. Risk of market volatility. The cryptocurrency market is highly volatile, and the price of tokens can fluctuate greatly in a short period of time, which can lead to significant losses for investors. In conclusion, ICOs can be a viable fundraising method for blockchain projects, but they come with a high level of risk. It's important to keep in mind that investing in an ICO should only be done with funds that you can afford to lose. Chapter 8. Decentralized Finance, DeFi. Decentralized finance, otherwise known as DeFi, is a new financial ecosystem built on blockchain technology that enables the creation of decentralized, trustless financial applications. These applications allow for the creation of financial products and services that are transparent, accessible, and censorship-resistant. DeFi applications use smart contracts, which are self-executing contracts with the terms of the agreement written directly into the code. This allows for the creation of financial products and services that are transparent and trustless, as the code is open source and can be audited by anyone. Decentralized finance, DeFi, has several benefits that make it an attractive option for investors. 1. Accessibility. DeFi makes financial services more accessible, particularly for those who are unbanked or underbanked. This is because DeFi applications can be accessed via a smartphone or computer with an internet connection, making it possible for anyone with a digital device to access financial services. 2. Transparency. DeFi applications use smart contracts, which are self-executing contracts with the terms of the agreement written directly into the code. This allows for greater transparency as the code is open source and can be audited by anyone. 3. Security. DeFi applications use blockchain technology, which provides a high level of security and reduces the risk of fraud and hacking. Transactions on the blockchain are recorded on a public ledger, making it difficult for anyone to tamper with the data. 4. Censorship resistance. DeFi applications are decentralized, meaning there is no central point of control. This makes it difficult for any one entity to censor or shut down the application, making it more resistant to censorship. 5. Inclusivity. DeFi has the potential to make financial services more inclusive as it enables the creation of financial products and services for a wide range of individuals, regardless of their location or socioeconomic status. Some examples of DeFi applications include decentralized exchanges, otherwise known as DEXs, allows users to trade cryptocurrencies directly with each other, without the need for a centralized intermediary. Lending and borrowing platforms allow users to lend and borrow cryptocurrencies using smart contracts, and stablecoins are digital assets that are pegged to the value of a fiat currency or other asset. However, DeFi also possesses several risks that investors should be aware of. 1. Smart contract vulnerabilities. Smart contracts are open source and can be audited by anyone, but bugs and vulnerabilities can still exist. If a vulnerability is exploited, it could result in the loss of funds. 2. Lack of regulation. DeFi is largely unregulated, which can make it difficult for investors to protect their rights and recover their investments in case of fraud or mismanagement. 3. High volatility. The value of DeFi assets can be highly volatile, which can lead to significant losses for investors. 4. Lack of investor protection. Unlike traditional investments, there are no investor protection laws in place for DeFi. Investors have little legal recourse if things go wrong with the project. 5. Security risks. Investing in DeFi also carries security risks, such as hacking, phishing, and other forms of fraud. DeFi has the potential to disrupt traditional finance by making financial services more accessible and inclusive, particularly for those who are unbanked or underbanked. It also allows for greater transparency and security, as the use of smart contracts and blockchain technology can reduce the risk of fraud and hacking. However, DeFi also possesses new risks, such as the potential for smart contract vulnerabilities, lack of regulation, and the potential for high volatility in the value of the assets. In conclusion, decentralized finance, DeFi, offers a new financial ecosystem built on blockchain technology that enables the creation of decentralized, trustless financial applications. It is important for investors to be aware of these risks and do their own research before investing in DeFi projects. Chapter 9. Regulations and Legal Considerations. One of the most significant challenges facing the cryptocurrency market is the lack of regulation and legal clarity. Different countries have adopted varying approaches to regulating cryptocurrencies, and this can make it difficult for investors to understand their rights and obligations. In this chapter, we will explore the regulatory landscape for cryptocurrencies and the legal considerations that investors should keep in mind. Regulations. Regulations for cryptocurrencies vary widely from country to country. Some countries, such as China and South Korea, have taken a strict approach and have banned cryptocurrency trading altogether. Other countries, such as the United States and Canada, have taken a more permissive approach, allowing trading but implementing strict regulations to prevent money laundering and other illicit activities. In the United States, the Securities and Exchange Commission, the SEC, has classified cryptocurrencies as securities, which means they are subject to the same regulations as other securities. This includes the requirement for cryptocurrency exchanges to register with the Securities and Exchange Commission and comply with anti-money laundering and know your customer regulations. In Canada, the Canadian Securities Administrators, CSA, has issued guidance stating that cryptocurrencies may be considered securities and therefore subject to securities laws. This includes the requirement for cryptocurrency exchanges to register with the Canadian Securities Administrators and comply with anti-money laundering and know your customer regulations. In the European Union, the European Securities and Markets Authority, ESMA, has issued warnings to investors about the risks of investing in cryptocurrencies and has called for stricter regulations to be put in place. Legal considerations. Investors should also be aware of the legal considerations surrounding cryptocurrencies. Some of the most significant legal issues to keep in mind include 1. Taxation. It is important to be aware of the tax implications of investing in cryptocurrencies. In most countries, gains from the sale of cryptocurrencies are subject to capital gains tax. 2. Smart contract disputes. Smart contracts are self-executing contracts with the terms of the agreement written directly into the code. However, disputes may arise if a contract is not executed as intended. It is important to be aware of the legal recourse available in case of a dispute. 3. Cybersecurity. Cryptocurrency exchanges and wallets have been the target of numerous hacking attempts. It is important to be aware of the legal protections available in case of a successful hack. 4. Investor protection. Unlike traditional investments, there are no investor protection laws in place for cryptocurrencies. Investors have little legal recourse if things go wrong with the project. In conclusion, regulations and legal considerations are an important aspect of the cryptocurrency market that investors should be aware of. It is important for investors to keep themselves informed and do their own research before investing in cryptocurrencies. Chapter 10. Advanced Cryptocurrency Use Cases. As the cryptocurrency market continues to evolve, new and innovative use cases for cryptocurrencies are emerging. In this chapter, we will explore some of the most cutting-edge use cases for cryptocurrencies, including 1. Decentralized marketplaces. Decentralized marketplaces, also known as peer-to-peer marketplaces, use blockchain technology to enable buyers and sellers to transact directly without the need for intermediaries. These marketplaces are decentralized, meaning they are not controlled by any singular entity and are often built on top of existing blockchain platforms such as Ethereum. 2. Stablecoins. Stablecoins are a type of cryptocurrency that is pegged to the value of a fiat currency or other asset. This makes them less volatile than other cryptocurrencies and more suitable for use in everyday transactions. 3. Non-fungible tokens. NFTs. NFTs are a type of digital asset that represents ownership of a unique item or piece of content, such as artwork or music. They use blockchain technology to ensure that each NFT is unique and cannot be replicated. 4. Decentralized finance, DeFi. DeFi is a rapidly growing sector of the cryptocurrency market that uses blockchain technology to create decentralized financial services, such as lending, borrowing, and trading. These services are often built on top of existing blockchain platforms such as Ethereum. 5. Supply chain management. Blockchain technology can be used to create an immutable record of transactions in a supply chain, enabling greater transparency and traceability. This can help to reduce fraud, increase efficiency, and improve trust between different parties in the supply chain. 6. Identify verification. Blockchain technology can be used to create decentralized digital identities that can be used for identity verification and authentication. 7. Internet of Things, IoT. Blockchain technology can be used to create secure and decentralized networks of IoT devices, enabling them to interact with each other and with other networks in a trustless manner. In conclusion, the cryptocurrency market is constantly evolving, and new and innovative use cases for cryptocurrencies are emerging all the time. As the market continues to evolve, it is likely that many more use cases will emerge, and it is important for investors to stay informed about the latest developments in the field. Chapter 11: The Future of Cryptocurrency. The cryptocurrency market is still in its infancy, and the future of this technology is uncertain. However, there are many potential developments and use cases that could shape the future of cryptocurrency. Some possible future developments include: 1. Wider acceptance. As the public becomes more familiar with cryptocurrency, it is likely that more businesses will begin accepting it as a form of payment. This could lead to greater mainstream adoption of cryptocurrency and make it more accessible to the general public. 2. Increased regulation. As the cryptocurrency market grows, governments and other regulatory bodies are likely to take a more active role in regulating it. This could lead to increased oversight and accountability in the market, which could help to reduce fraud and protect consumers. 3. Decentralized platforms. More decentralized platforms, such as decentralized marketplaces and decentralized finance, could emerge in the future. These platforms could enable new and innovative use cases for cryptocurrency and could help to democratize finance and commerce. 4. More stablecoins. As the market matures, more stablecoins could be created and used as a medium of exchange and store of value. 5. Advancements in security. With the increasing number of attacks on cryptocurrency exchanges and wallets, there will be a need for more advanced security measures to protect users' assets. 6. Interoperability. As the number of blockchain platforms and cryptocurrencies increases, there will be a need for greater interoperability between them. This could enable users to more easily move their assets between different platforms and use them in different contexts. 7. Increased institutional adoption. Institutional investors are beginning to take notice of the cryptocurrency market, and it is likely that more institutional money will flow into the market in the future. This could help to increase liquidity and stability in the market. In conclusion, the future of cryptocurrency is uncertain, but there are many potential developments that could shape its future. Wider acceptance, increased regulation, decentralized platforms, more stablecoins, advancements in security, interoperability, and increased institutional adoption are just a few examples of the potential developments that could shape the future of cryptocurrency. It is important for investors to stay informed about the latest developments in the field and to be prepared for the potential changes and opportunities that may arise in the future.